Joining our closing bell exchange today, talk about this market, Greg Sarian, Managing Director of the Sarian Group at Hightower. Stephen Guilfoyle is back, contributor at Real Money, and Rick Santelli joining us from the CNBC Group in Chicago. Sarge, we've got a pretty broad-based rally, whether it's teeing off of a little bit of strength in the Turkish lira. What does it say to you that this market has been resilient and rallies in the face of decent news?
The market's been resilient in the face of the trade wars that have been hitting us over the head now for several months. I think the market is actually poised to go higher. You have corporate tax rates, you have deregulation, you got GDP above 4%, you got unemployment below 4%. You saw the household debt-to-income ratio today, right? That's a huge improvement for this economy. It means that these tax cuts are really extending to the consumer past corporations. I believe that if we can get past 2862 and then 2872 on the S&P, we could have something of a melt-up autumn. Now, the midterms, of course, could get in the way of that, and that's President Xi's game. You saw the Chinese macro today, right? Deep in the hole on 5 different categories. China's starting to suffer a little bit, but if Xi can hang on till November, there won't be a regime change here, but there could be a swing in power, and that could play into his hand.
Rick, what's your take on that China data that we saw earlier? Do you think China's feeling the heat of these trade wars, trade disputes more than the U.S. is?
Listen, a picture's worth 1,000 words. Just put a year-to-date chart of the Shanghai Composite on top of the S&P or the NASDAQ or the Dow. Absolutely. The Chinese economy was probably already having issues before this. They're not going to win. How long they stick around and try to poke more anxiety into the equation or respond in kind, I can't answer. But in terms of markets, the only turkey that's affecting investors today is the one that's in November. Stock market looks good. Interest rates are moving up in a slow fashion, which is good. And it really shows based on the short end, the curve flattening to your note yields almost leading the way today, that the flight to safety, the parking, if you will, is probably mostly over. The dollar's doing well. Listen, if you didn't pay attention to some of the issues that Sarge has brought up, truly, the markets look fine here. As a matter of fact, it's hard for me to imagine that investors wouldn't be somewhat enamored. I can't wait to see if retail sales kicks in a little bit of horsepower productivity tomorrow morning.
Well, certainly the retail stocks are leading the charge in this market. Greg, consumer discretionary up 1%, Tapestry off good earnings up 12%. Pretty much all the retailers are higher right now, which also paints a pretty good picture, as Sarge and Rick were saying, about the U.S. economy and the spending picture. Is that where you want to be in terms of exposure in the stock market?
I don't disagree with what the others have said, but I do think, Sarah, that the consumer is facing some headwinds here. Investors are facing some headwinds. The markets are within 1% of all-time highs, and if you listen to what Fed Chairman Powell said a couple weeks ago, they see data points as strong. That was his adjective of choice, so we interpret that as rates are going to be moving higher in September and possibly December, thus causing some competition for stocks. I also think we have some challenges with earnings deceleration. We've had a great year of earnings, best year since 2010. Q3 is expected to be strong as well. How can that pace continue? And what will investors do if the markets react adversely? We think people want to consider raising some cash here, not running for the hills, raise some cash, do some rebalancing to some sectors that have been out of favor.
Sarge, your take?
Well, it's funny you just spoke about cash, because I've just went to the lowest cash level I've been at all year. And I have been at high cash levels all year, pretty much since January. Now, my cash levels are normally higher than other Wall Street guys, so I'm not going to say I'm down to 5% or 10%, but I'm up in the 20s. And I had been as high as 46%. I even spoke with you about that on air.
But what about what Greg just said? I mean, you mentioned a big risk is the midterm elections. A lot of people think the big risk is the Fed continues to plow forward with raising rates.
I can agree with that, too. Now, the balance sheet management program goes higher again, I think, in October. Running that simultaneously with the increase in the Fed funds rate, I do see as a risk. And that could potentially tighten monetary conditions, but monetary conditions are still probably easy enough where I think that might be a next year's story if it carries on. And next year's Fed, the FOMC, is a slightly more dovish composition than this year's.
But so in terms of you deploying the cash now, so you've missed a large part of the recent rally?
Oh, no, I have been reducing cash all along, but I am currently down to a level in the high 20s, which 25 is my normal level. So I'm not that far away from my normal cash level at this point.